Hello, everyone. Thanks for joining us today. Our WorldStar strategy has continued its strong performance this year, outperforming the global equity market. As before, the webinar will be led by Jerome Stern and our CIO, Chris Rosbach. They will be joined by Giles Tallock, who leads our technology coverage and is a partner of the firm. After the presentation, we'll move to Q&A. We already have some good questions, and please do send more at any time during the call. I'll now hand over to Jerome.
Thank you, Sandy. A warm welcome also from me to our September WorldStars Global Equity webinar. We look forward to a great update today. A bit of background first. We're an investment partnership managing $1.9 billion AUM on behalf of institutions, endowments, wealth managers, trustees, and families, whereas 20% of this AUM is managed on behalf of my families and our partners, providing investors with an unparalleled, powerful alignment. At J. Stern & Co., we manage a small number of high-performing, high-conviction, concentrated investment strategies on behalf of long-term investors based on fundamental research with a core focus on quality. Our flagship investment strategy, WorldStars Global Equity, represents $1.6 billion AUM, of which $300 million is in a Luxembourg UCITS fund and $400 million in a Delaware LP fund, which we successfully launched earlier this year to offer our strategy to eligible US investors. I'm proud to highlight that WorldStars has delivered strong returns since inception, which Chris will describe in detail later. This performance builds on the quality of our investment proposition, the diversity and stability of our equity investment team, having worked together for more than 10 years, as well as the repeatability of its institutional investment process and its available investment capacity. Moving on to our investment philosophy, remember, quality is the defining condition for us to invest in a company. We define quality as a strong and sustainable competitive position in a good and growing industry, with a company managed by a strong management team with a great track record of value creation, as well as a balance sheet strength in order to be able to weather any adversity. If a company does not display those qualities, it can be as cheap as it wants. We will just not invest. We're extremely selective in our approach. We concentrate our efforts on only 4 industries: digital transformation, global consumer, healthcare and life sciences, as well as industrials and infrastructure. Equally focused, we avoid other industries, such as banks and insurance companies, resource companies, regulated industries, as well as capital-intensive businesses. We are looking forward to celebrate in 2 weeks our WorldStars Global Equity Strategy's 12th anniversary. During that time frame, we have shown time and time again that we create value through taking a long-term horizon when other market participants follow shorter-term objectives. As you see in this analysis, WorldStars has outperformed the MSCI World in 68% of all the 3-year rolling periods since its 2012 inception. This continues to show consistency and reliability of our investment process. As highlighted by Roger Federer in a now famous speech, whilst he won 80% of the 1,526 singles professional matches he played in his professional career, he only won 54% of the points he played in those matches. As much as we would like to always be right, we therefore see outperforming in more than 2/3 of the 3-year rolling periods for 12 years as a pretty good result. At this stage, I'll hand over to Chris.
Thank you very much, Jerome, and welcome to everybody, those of you who are regular listeners, as well as those who are joining us for the first time. I want to start by picking up on what Jerome said in terms of the performance of the WorldStars Global Equity Strategy. As you can see, we have continued to perform strongly. The strategy is up at the end of August, 18.1%, net of full fees of 1% and 19% before fees, strong absolute performance, but also outperforming the MSCI World Total Return. And we're pleased that that also means that we have continued to perform strongly in absolute and in relative performance terms over the period since our inception, as well over the past 10 years. You can see, however, as Jerome was highlighting, that that's not always the case. I think as the graph shows, and as we're seeing just this month, there will always be volatility, whether that's a result of overall global geopolitical events as we've had, like the pandemic or the Ukraine conflict, or whether it's as part of global macroeconomic events, like the significant change in inflation and in interest rates that we've seen. And that we're about to get to a major turning point in terms of the US Fed decision that we're expecting tomorrow, and to the outcome of which, in terms of the signaling, whether 25 or 50 basis points will mean that the Fed is being proactive and continuing to successfully manage the US economy, or whether it's too much or not enough. I think, as we've said, one of the big issues is that in a moment like we're in right now, where it's about Goldilocks, in the fairy tale, in Goldilocks, the porridge is just right. But in reality, it's always too hot or too cold. And that's simply something we have to understand and respect, and focus on the fundamentals of the businesses that we invest in. If we move forward to see what has been driving this, it's often the factors. We've showed you this analysis before, and as you can see here, the active return is the gray line since big January of 2020, so really just before the pandemic. The pink line is the factor return, the factors that we're exposed to. That's primarily the sectors that the WorldStar's Global Equity Strategy is exposed to as a result of our focus on quality and on the valuation of the companies, and buying at the right prices in order to generate strong compounding returns. And then the selection effect, which is ultimately what we do, which is to simply pick the right stocks. And what you can see here is that throughout that period, the selection effect has stayed positive. It's dipped down to flat on 2 occasions. The second during the big rotation that took place when interest rates normalized at the end of 2021 and through 2022. But you can see it stayed as flat. It declined with some things that happened with some of the stocks in digital transformation and digital advertising, but also others. But what you can also see, if you follow the pink line, is that the pink line's declining, the selection is staying stable. The first thing that happens is that the pink line changes. That is the market, quantitative funds, trend followers repositioning themselves in the short term. But very importantly, you can see that the pink line has stayed flat and has actually declined slightly throughout that entire period, whereas our performance has been strong, driven by the selection of the stocks. That's what we do, is to pick the right companies. It doesn't mean that we're not exposed to factors, and you can see the active return being influenced by it. But ultimately, we think that the criteria we're looking for in terms of the quality of the businesses and their ability to grow and to compound over time is what is going to be driving returns. And I think we'll get to it at the very end in terms of what that means for the positioning of where we are now, given the environment that we're in. If we then turn to the attribution analysis for what the portfolio has done on a year-to-date basis, we've grouped it here by GIC sectors, which are the official comparisons that we can use for our portfolio and risk analytics systems. And what you can see here is that we have been consistent in terms of being able to pick the right stocks. The over and underweights of the portfolio are relatively modest in terms of the allocation effects, in terms of what has helped us or what has hurt us. And what you can see is that the positions in information technology, where we're actually roughly equal weight compared to the market, in industrials, an area that is of great importance to us, because we think there are great industrial companies that are helping to solve the problems of that we're facing, and that are benefiting from the need for sustainability and issues like the transition to net zero decarbonization and so forth, where great investment is being put in, and communication services is where we've added the value on a year-to-date basis. You can also see in terms of consumer staples and healthcare, as well as financials, where we own MasterCard, which is a payments company, that we have had issues, and that the stocks that we have selected have not performed. We will talk about, in particular, consumer staples and the opportunity we see there. We have been able to act proactively, really since the pandemic, to trade, to adjust from a portfolio perspective, as well as from a valuation and fundamental perspective, to sell parts of positions and entire positions in stocks that have either performed strongly or been resilient, and to reallocate those to stocks that we think are opportunities, whether that's new positions or whether that's adding to positions that we already have. And it's specifically in that area of consumer staples where we have been adding to the portfolio. If we turn to the returns and the disaggregation of that to the 31st of August, then I think you can see another very important aspect of what is driving the performance of our portfolio. On the one hand, it's the stock selection, but then in terms of the classification that we have ourselves, the areas that we are attracted to that Jerome was alluding to earlier and that you're familiar with, as opposed to the ones that we're trying to avoid because we think they don't fulfill our criteria as much. You can see that the strongest performer on a year-to-date basis was NVIDIA. We continue to be very confident in terms of its fundamental prospects, and we think that its valuation is attractive. But you can see that the other performers have been across a number of companies and industries that we're exposed to. The next best is RTX, which is the large avionics and defense industry, Meta, the platform, Amphenol and Eaton, the industrial companies, and then with the color coding, you see the diversity of companies that have contributed to that. The other thing you can see, and you saw it earlier in terms of the attribution slides as well, you can see on the bottom left where the problem is. It's a number of the great consumer products companies we own, Pernod and Ricard and Spirits, which is going through a significant issue, as well as LVMH and L'Oreal, which are more on the consumer discretionary side. And as I said, these are specifically at the areas where we are now, where we have been buying stocks because we think the valuation opportunity is so great. If we turn to the earnings outlook, another way of looking at what's going on this year is that you can see a similar pattern. We are very pleased that the majority of our stocks, despite all the challenges, in particular the economic slowdown, and in even more particular, the slowdown in consumer spending, driven by the higher inflation and the higher rates having an impact on what's going on. You can see that we have a diversity of stocks that have done well in terms of the earnings, in terms of the outlook that they've provided at the Q2 point this year. You can also see that of the 6 stocks with lower estimates, the majority are in consumer products, and that is the squeeze taking place that is entirely expected, that we think is now more than over discounted in terms of where these stock prices are. Turning to the active weights, another way of showing you what is in the portfolio and what the drivers are, it furthers the point about the diverse drivers and exposures that we have. Looking at the performance, you might say, well, that's all tech and it's all NVIDIA. But what you can see here, if you look at the underlying exposures that we have, then you can see that the largest overweight we have, we've shown you the 5 here, is actually Eaton, the industrial company, followed by NVIDIA, LVMH, and then ASML and Amphenol, which is an industrial stock. And should be in dark blue on this chart. So these are a diverse set of companies that represent the significant stock selection and that we're making as an investment team. And if you look at it on a GIC sector basis, you can see the positioning is very much in line with what we're looking for with quality, because the big overweights there compared to the MSCI world are in industrials and communication services and healthcare and in consumer staples, specifically the area that has been held back so badly and that we think shows a lot of promise, materials. And you can see we're actually equal weight, very slightly underweight information technology. So it's not by making sector bets that we are having this exposure, and we think that it's a very resilient and diverse positioning in terms of what it is. I think it's very important to say that these are the outputs of our stock selection that we use in terms of understanding what risks we're taking, but it is driven by the underlying stock selection. And that's reflected, if we continue, in terms of the active trades that we've done on a year-to-date basis. We have sold some stocks. We have sold parts of the position in NVIDIA, an Eaton, and an Amphenol. We've highlighted that in NVIDIA. It is for portfolio management and risk management considerations. We have a 10% hard position size limit for positions in the WorldStars Global Equity Strategy. NVIDIA has breached that 3 times over the last 9 months, and so we have sold an aggregate of 390 basis points of that. And we also sold in aggregate 150 basis points of Eaton and Amphenol, the leading industrial companies that we own. And here it is a view on valuation. The companies have performed extremely strongly. We have our absolute price targets in terms of the discounted cash flow valuation. That's the core of our valuation approach. But we do also look at price to earnings ratios over time. And in both cases, the stocks have closed some of the valuation gap that we've seen. And so we've decided to proactively sell parts of those positions and reallocate the capital to positions that we've had in part on our watch list and approved list, and that we think have become opportunities because of the valuations that have been offered by the markets, and in part to reinforce existing positions that we have, in particular in some of the sectors that have been held back. And so you can see we added the position in Zoetis that we've talked about, the world's leading animal health company that I'll talk about in a moment. We added to ASML, and in particular, we've added to some of the consumer and industrial stocks that we felt have been significantly held back, and that is what we've been doing in particular in the first half of this year to take advantage of the opportunity that we see there. So with that, let's turn to some of the stocks and some of the perspectives that we'd like to share around these. The first one I want to talk about is Zoetis. The global leader in animal health. We have talked about it when we introduced the stock, when we first bought it in the portfolio, but we think that it is extremely attractively positioned in a structural growth industry with a strong market share, significant reinvestment in R&D, and we think therefore significant prospects for value creation. You can see that the stock has had a volatile run since its IPO. It ran up in part during the pandemic because of the boom in companion animals, pets, that people bought with the difficult comparisons. It had a more challenging time, and we have been watching the company and having it on our watch list and then approved list pending the valuation opportunity. And what's happened is that it effectively has grown itself into its valuation, and so it allowed us an opportunity to buy it at significantly lower prices. We think that it's now very well positioned, and if we turn to some of the global franchises that it has, it's in very important categories. One of the most important products they have is a product that is a drug for arthritis in dogs, but also in cats. Those of us who have pets know that they, over their life cycles, they have mobility issues, which affects their quality of life and the way that we can interact with them. So it is a tremendous innovation that Zoetis has developed, and that we think has very significant opportunities, in particular as it becomes a product that is more both vets and pet owners are more familiar with and can very significantly improve the quality of life and the experience that people have with their pets. And the second is a product that is a parasiticide. We all know, those of us who have dogs, how important that is. And again, here, the market itself is growing very significantly. It's a leading product, and it has a high degree of functionality. And so we think that the company will be able to participate in that growth going forward. So we continue to be very positive about Zoetis. It's been held back a bit this year, but again, we think it's moments like these that are opportunities for us. And then turning to another stock that we've owned for a long time, Roche. It is the leading pharmaceutical company with a strong franchise as well in diagnostics. It as well has offered a significant opportunity. It has had a challenging time since the pandemic. It ran up. It has had pharmaceutical pipeline issues that have held back its growth. It had benefited significantly from the testing. That was one of the features of what healthcare companies did to contribute to us overcoming the pandemic. The after effects, of course, we're still feeling and that are still rippling through the global economy and through companies, but it derated very significantly over time, in part because of concerns around growth and concerns around their pipeline. But we think that they have been reinvesting and have a strong outlook. There is a new CEO since the beginning of this year who is driving change and innovation. So we think that that is a very positive decision that they've made, and we're expecting an acceleration in the underlying growth of the business. And as you can see, it has started to perform. It had a difficult time, but again, we think it's a tremendous opportunity. And here in particular, it's a very significant valuation opportunity. If you look at a price to earnings multiple of 14 times and a free cash flow yield of almost 6%, these are very cheap valuations for the franchise that it has. And so we're not at all surprised to see that the stock has started to perform. It's early days, but we think it's a tremendous opportunity. And just shifting to some of the detail here in terms of the growth opportunities that the company has, there's a number of new products that they have in their portfolio, both in terms of approval and reapproval in some specialty categories. And importantly, they have a very active product pipeline in important indications. So we think that in the next 12 to 18 months, there will be significant clinical readouts on this pipeline. Of course, not all will work, but we think that there are significant opportunities here that will continue to drive the share price. And then I want to turn to our consumer stocks that we've talked about, the pink bars that have typically been at the bottom left of the charts that we've showed that have been held back and that we've been buying. We've just highlighted here some of the information. It's Diageo and Pernod in spirits. It's Nestle in food and other pet care and other categories. It's LVMH in luxury, and it's Walt Disney as a global media company that is also providing entertainment and through the parks that they have. And each of them have been significantly impacted by the slowdown in consumer spending, the squeeze from the inflation, the squeeze from the higher rates, and now the slowdown that is taking place as a result of that, which has been bringing inflation down and which has led us to this turning point in terms of the US interest rate policies. We think in each case, the underlying franchises are strong, that the issue that they're facing is cyclical, not secular, that therefore they have significant prospects of regaining, of having strengthened their business, of going back to growth as they themselves get over difficult comparisons and as consumers resilient consumers start to see the benefits of the lower inflation and the imminent rate cuts, which are going to take place in the US and have obviously in many important countries already started in terms of where that interest rate cycle is. And very importantly, you can see that their current valuations are at significant discounts to both 5 and 10-year averages. Some of that, of course, has to do with rates, but if you think about it, we're now at a point where rates have clearly normalized, and where US rates at the levels where they're at are at what we think is a very realistic and sustainable level in terms of the market pricing for 10 years. And we think, therefore, that these valuations that these stocks are trading at are a significant opportunity. And I would say that in the same way, we said when we were in 2022, and we were buying NVIDIA, and we were buying Disney, and then we bought ASML, and then we bought more. It was an extraordinary opportunity to buy these high quality companies, leaders in digital transformation, or consumers in the case of Walt Disney, at valuations that are extremely attractive. And we've seen the majority of them perform. We're still very optimistic about Walt Disney, of course, but it has. But in the same way, it was an opportunity to buy those stocks in 2022, in the same way that it was an opportunity to buy those and other stocks in the third and fourth quarter of last year, when we had a similar wobble, I think is a technical term, as we're having this year. In the same way, we think it is an extraordinary opportunity to buy high quality companies, but in particular, these globally leading consumer products companies that have been held back by the short-term concerns that people have, and that are at valuation levels that we do not see very often. And just to highlight the point, just to talk a bit about Nestle, which is a core position for us, which has had a challenging time in terms of its share price and its valuation. As we've seen there, they replaced their CEO over the summer. We have been following the company very closely, and certainly had an impression that the company was in need of new leadership to reinvigorate growth, to focus back on the strong positions they have in key categories, after the achievements that Mark Schneider, the outgoing CEO, had achieved in terms of the strategy and in some of the realignment of the portfolio, but still leading both to fundamental issues in terms of execution, but also to market-related issues related to guidance and to surprising markets. So we think that it's at this point an extraordinary valuation opportunity. The reason why we're showing you these quotes, the first one from the Financial Times, the lower one from Barron's, is because these are articles in which we were substantially quoted in terms of our views of what the dismissal of Schneider and the appointment of a new CEO would mean. It's part of our engagement. We think that as active shareholders, we should also be active participants in the public debate around these issues. I think it shows that our views are taken seriously by publications that are helping to shape the opinion. And so we think it's both a part of the stewardship of the assets that you have all entrusted to us that is a part of this, but it is also about engaging with the companies and having an impact in terms of potentially shaping where some of these discussions going, the discussions that we have with the senior managements and with the investor relations of these businesses. And then just to focus in terms of where we think that Nestle can extract more value and where the change of priority might take place with the new CEO, Katerina Cosmopoulou, our partner who covers Nestle, and I were in Vevey earlier this year, and as I said, had the impression that there really was a need for a refocus on what Nestle is about, which is about consumer brands, about solutions, and about the type of growth that can be achieved. And so we think that that is now something that the new CEO can focus on. And they've had a significant renewal that's taken place. Anna Mans joined from LSEG, the London Stock Exchange, but had before that a career including at Diageo, and I think is a strong CFO with a strong record also of communications. There's a new head of investor relations. And so both in terms of the fundamental focus, which is critical on the brands, but also, as I was alluding to, the focus on communications and guidance, which is critical for businesses of the scale of Nestle. We think that there's a turnaround moment that is taking place. And most importantly, as I've been highlighting, is the valuation that we think is really what is going to drive things. And so picking up on the valuations, if we turn then back to a perspective on the portfolio as a whole, we've shown you here some of the sector weights and valuations that we see in the portfolio. So again, it's grouped here by the classification that we have ourselves in terms of the underlying drivers of the businesses. And we're comparing it on a weighted average basis for the WorldStar's global equity strategy and the MSCI World. And I think I want to highlight one thing that is something we've always talked about, and we'll see as we have the comparison towards the end as well, which is the overall reasonable valuation of our portfolio, in particular as you look at not just 2025 but 2026, the earnings that were expectation, and you can see that's really across the board in the different areas that we invest in. But I think the thing that I really wanted to highlight here is it's in particular true for digital transformation. So despite the fact that NVIDIA is our largest position and also our second largest overweight, you can see on a weighted average basis, it's not just NVIDIA's valuation that we think is attractive, as we'll get to, but you can see it's true for the overall allocation, which amounts to just over 40% of the exposure, that we think it's extremely reasonably valued. And therefore, while markets may be more fully valued, while there are companies in markets that we don't own that we think are either very fully valued or expensive, that is not the case for our portfolio. So in a moment like this, where people are concerned around markets, the fact that we invest in companies and not markets, and that we are very conscious about the valuation of the companies that we have, even as we think they have attractive and long-term growth prospects, is something that we think is very important and we take very seriously. So with that, I'll turn it over to Giles, who is a partner in our firm and who works on our digital transformation stocks, among other things, to talk a bit more about NVIDIA.
Great. Thanks very much, Chris, for the introduction. Yes, I want to spend just a couple of minutes talking about NVIDIA. It's very important, not only to our portfolio, but also to the broader sort of stock market. And we've sort of had this slide here from one of the latest presentations from NVIDIA, and we think it's very important to talk to. So NVIDIA right now gets a lot of attention for its GPUs, and you can kind of see that at the top of the page, where it has sort of the Hopper GPU, the Blackwell GPU, and the Rubin GPU at the very top. But it's an entire platform that NVIDIA are selling. So it sells down through the stack, and you can see the other sort of 4 other products here highlighted on the screen, be it the CPU, but also the NVLink, NIC, and switch, that NVIDIA are basically designing products to enhance the sort of GPU. Each of these are sort of fully optimized in order to give sort of superior performance. And so NVIDIA have created their own type of, essentially an ecosystem around the GPU to improve the performance and extend the competitive advantage. But also as well, it's on a 2-year cycle. So you can see here Blackwell's 2024, 2025, but also there's an annual refresh as well. So this annual refresh essentially avoids the kind of boom bust cycle that you might see within other sort of semiconductors and other products, where customers, for example, if they know something new is coming down the line, they'll just wait and hold off on orders. If you have an annual refresh, it avoids this because you might as well buy what's available right now. Also as well, it extends the competitive advantage. So whilst another competitor might basically try and match the existing specs, NVIDIA have leaped to the next generation. Also as well, we think it's very important that it shows Rubin out to 2026 and 2027. NVIDIA has sort of visibility in its own development and its own sort of pipeline of innovation, but also as well, if they're willing to share this with the financial markets, you can be pretty sure they're sharing this with their sort of key customers, most likely under NDAs, but they're basically telling their customer base, look, this is what we're producing for 2026, 2027. If you want to build your data centers, which of course require a lot of infrastructure, not just in the construction, but also power and the energy, and with the cooling, which is necessary to go on, you can see this basically this roadmap which we've got going forward into the future. And so we've seen actually customers right now are seeing the Rubin platform, but they're also ordering for Blackwell and still also ordering for Hopper. So in the last quarter alone, NVIDIA said that demand for Hopper is still increasing, is accelerating. So whilst Blackwell's ramping in the sort of fourth quarter of this year, the Hopper revenues are still accelerating. Hopper's not taking away demand from Blackwell. They're working in tandem. They obviously, Blackwell, whilst it's much more powerful and much stronger, there's still a lot of demand for Hopper out there. And then turning to the next slide, we thought it was just interesting to sort of show it on a visual basis. Sometimes it might be quite difficult to kind of see these things just sort of conceptually. We can see here just the size and scale of the racks, as well as the products that go into it. And then if we turn to the stock specific slide, just on NVIDIA, there's a couple of points which I want to sort of highlight here again. Firstly, obviously the share price chart, as Chris mentioned, we've had to sort of reduce the position a few times over the last couple of years that we've owned the stock, but also as well, NVIDIA basically got an entire sort of ecosystem. So whilst I showed the platform of the sort of Hopper and the Blackwell, you also have CUDA, which is their sort of software language for programming, as well as sort of software libraries that are available for basically for companies and enterprises to advance their artificial intelligence. You're also seeing a very strong breadth of demand. So whilst there's sort of a lot of talk about big tech companies, the likes of say Meta and Microsoft, you're also as well seeing sort of sovereign governments creating their own centers of excellence because they don't want to leave artificial intelligence in the hands of sort of corporates. The governments also want to be able to control the destiny. And as well, of course, you've got large enterprises as well who also see the benefits of artificial intelligence. The management team are exceptional. You can sort of see the vision that they have and also sort of see this path of artificial intelligence. They're also very efficient in terms of their execution, in terms of firstly the pipeline, but also as well securing enough orders from the sort of supply chain out in Taiwan, been able to increase the cadence of production and to make it go faster and faster. It's all very, we really rate the management team very highly at NVIDIA. And then lastly, on valuation, we still think NVIDIA trades very cheaply, especially compared to its growth rate. We have seen on sort of websites like LinkedIn and forums like that where people think that it's a bubble, and we kind of want to dispel a couple of those myths. Firstly, you sort of see these charts sort of a price to sales ratio of NVIDIA, and it might look optically high at 40 times price to sales, but we think this is completely the wrong metric you should be using when looking at NVIDIA. Price to sales is when those companies don't make any earnings. NVIDIA does operating margins of about 65%. So that sort of 40 times price to sales is actually like 26 times price to earnings. Secondly, I see people doing charts of the sort of trailing 12 months, looking backwards in time as to what NVIDIA have done, thinking it looks expensive. What we're looking at with NVIDIA is the future growth, what it's going to earn this year and next year and going out further forward. And especially when NVIDIA basically doubled their revenues last quarter and tripled its earnings, it's much more relevant. So when we're sort of making our forecast and triangulating, firstly, the demand for artificial intelligence, we're looking at the overall money spent on sort of compute power, spent on data centers. We look at the value that artificial intelligence brings to companies. So the likes of Meta, they've spoken a lot about the impact that artificial intelligence has had on their business, where they've been able to grow revenues by 20%, but also as well, operating margins have increased by almost 1,000 basis points as they're able to be much more efficient using AI not just in sort of recommending the next advert, but also as well in terms of the conversion and delivering better attribution for its advertisers and customer base. So companies are able to accelerate earnings, do it much more profitable. So we think that will basically drive much more demand for NVIDIA's products, as well as looking at the supply chain, talking to companies based in Asia who are doing a lot of the manufacturing, and we're seeing what sort of orders NVIDIA are placing and what demand they expect. We're very comfortable to see a very strong path of growth for NVIDIA, not just over the next year, but the next sort of 2 to 3 years. And so in conclusion, we think AI is really still at its infancy. We're really at the foothills of demand here. We can kind of see some of it going in waves. So there will be sort of rushes of excitement, but we think that overall AI will have an impact, not just in the technology sector, but also across many other sectors, in say healthcare, in industrials, say for example robots, as well as consumer. It'll be across the back office in terms of legal and finance roles, but also in terms of front-facing roles, such as in sort of sales and demand generation. And we think it will just be like the internet, which will basically transform the way that we do business, and companies will have to adopt AI. And so with that, it's NVIDIA. They're the main company enabling all of this. And as we see much more powerful large language models coming down the line in the next year or two, it'll basically be a much more higher spend on NVIDIA's equipment. And so with that, I'll pass it back to you, Chris.
Yeah, thank you very much, Giles. And we've obviously published insights on this that you can find on our website as well that I think highlight this point. And I think the thing that I would just add to that is to say that for us, quality is a forward-looking attribute that allows companies to generate value. It is not backward-looking. And so one has to understand the consistency that companies have. We do the screening that goes with that. But the key is the qualitative assessment in terms of doing the type of analysis that Giles just described and identifying where companies have these leading positions. But it is also just as important to ask the right questions. And I think that is something we have tried to do throughout the period in which we've been managing the WorldStar's global equity strategy, which is to ask the right questions, understand what companies are doing, how they're allocating their capital, where they're seeing opportunities for growth and for efficiency. This is the internet, this is SAP, and the big ERP systems that have allowed companies to manage their businesses globally. A company like Nestle has implemented SAP over a more than 10-year period from 2002 to 2013. And so they're only 10 years in being able to manage the business on a global basis. And we think this increase in computing capacity that we're seeing that is being enabled by NVIDIA and that is being aided and being implemented by many of the companies that we own is going to be transformative. As what Giles said, we are going to have looking for companies that will benefit from it, weary of companies who will be disrupted by it. It'll be, for example, something that will benefit economies of scale because larger companies clearly will be able to invest more in those. So all of these will be issues that we have to face. But again, the key is to identify them and then to ask the right questions of the companies and their managements as we talk to them. And so that I want to then just turn to the outlook and to then move into the questions in the remaining time that we have. We're clearly at a turning point in terms of the US interest rates and really the cycle that has taken us from the global financial crisis through the challenges that we faced, through the enormous and unprecedented disruption of the pandemic, to the normalization of rates where markets are now setting them and have for now close to 12 months, and to a point where the US Fed itself believes that the risk reward balance is poised to a point where they've achieved the objectives that they've tried to, where inflation is moderating, where we believe the underlying US economy is still robust, and where therefore it's appropriate to take rates back and to have a policy that is in line with the dual mandate that they've got. Again, Goldilocks is never just right. It's always too hot or too cold. Volatility is something that will happen. But if you look at the underlying numbers in the US, while things are slowing, consumers have still been in aggregate resilient. If you have been traveling in the US like I've been over a significant part of this year, you can see that the infrastructure spend, the signs that you see everywhere, that this road or this bridge or this other project has been funded by the bipartisan infrastructure bill, is everywhere. And so this period of reinvesting in the public and private asset base for the first time in decades, that we've been talking about, this period of applying technology for efficiency and productivity, this period still of strong employment and of increasing wages, closing the gap between the inflation and the rates that have reduced real incomes, and therefore alleviating some of the pressures on consumers. This is the moment that we're in. And so with the rate cut, we think that this is going to be a very important turning point. And as we've consistently said, when you have opportunities like this, whether it's because of market volatility, whether it's because of geopolitics, whether it's because of macroeconomics, whether it's because of short-term positioning by funds, these are the times of opportunities for long-term investors. And I think if we look at the risks, there are many. There are geopolitical risks that are significant, but they can also go either way. So conflicts will clearly continue, but they can also be resolved. We have China is clearly struggling with deflation. We have had a more positive view, but if you look at the transition that they're undergoing, it is very significant, and GDP is still growing, albeit at somewhat lower rates. And US elections in particular this year will clearly be very important and are highly uncertain. But this year has been a year of elections, many of which have had more moderate outcomes than have been initially expected, where some of the big moves and reinforcements of policies that have been expected have not taken place. It is very hard to predict what will happen in the US. There are pros and cons, both to whoever will win the presidential election and whoever will control Congress. And I think all of that is very much open. But at the same time, the US has done well with gridlock. Administrations have been broadly pragmatic in terms of their policies. And so we think the important thing is to focus on the companies. We are concerned, for example, around global trade, where there could be different outcomes depending which way the US election goes. But again, we've identified it as a risk. We're looking for our companies to be resilient and to understand the impact. And so we are really, we think that the portfolio will be resilient and it will be supported by the valuation opportunity. And so with that, I want to close just to look at this point that we think that quality is worth the price. If you compare the portfolio on a weighted average basis to the MSCI World, you can see that we have very significantly higher revenue growth that we're expecting, even short-term, higher earnings per share growth, far higher margins, reflecting the quality of the companies that we invest in, far lower carbon impact, so much less at risk of disruption, and much better position to take advantage of opportunities, and a valuation that is only moderately higher than the overall market, echoing the comments I made earlier in terms of where markets are and the dispersion of what it is. And if you think of where we are in an environment of lower but sustained growth, of more moderate but still sustained inflation, you want to own assets that can generate real returns. And those are companies that can grow, whether they're environments or their industries, that have pricing power to offset the inflation, that have scale so that they can absorb the cost increases, and that are cash generative and have strong balance sheets so they can act out of a position of strength to allocate capital by competitors or companies that can help them in terms of their market positioning or growth, and thereby generate value. And of course, that is just another way of describing what we are looking for in terms of the quality companies that we're looking to invest in. And as we've highlighted, we think the valuation opportunity today is compelling.